Hello and welcome to Wednesday webinar. Tonight I'm going to discuss estate planning. This is the first in a series of 2 webinars on the topic. It's all about how capital gains tax can affect your estate and what your beneficiaries end up with. Organising your estate to leave direct property to your heirs rather than the estate selling the property and distributing the cash could be a great way of minimising the tax on your estate. But there could be disadvantage for your children. You might leave them properties worth equal value, but some properties will have a greater tax liability than others. They inherit your tax liability. Should they choose to sell the property, then they will have to pay tax on the gain made during your lifetime and during their lifetime. This isn't the case with your own home, but I'll explain that later. You hope that your children will pass the property on to their children and that they can hold the property and borrow against it and enjoy the rent income and stuff like that and never have to pay the tax. So by planning carefully, you at least give them the opportunity to do this. Now, this topic is going to be addressed over 2 webinars to help you understand how to plan your estate. Tonight, I'm going to cover the cost base. When you sell a property, the difference between the price you got for it and your cost base is where the capital gains tax applies. So it is very important to know what each of your heirs inherit as a cost base on a property. So let's consider this basket of goodies. You may have a property that you purchased before the 19th of September 1985. This is the real jewel in the crown. Your heirs will inherit that at a cost base of the market value at the date of death. It doesn't get better than that. So if they sold it immediately after you died, there'd be no capital gains tax payable. In fact, they get up to 2 years to sell it and still have no capital gains tax paid. The only capital gains tax liability that will accrue is that after you die. Your home has very similar concessions. Its market value at date of death is the cost base and 2 years to sell. Now this is the case even if you were living in a nursing home when you die. You can still continue to cover your home with your main residence exemption. It's just under the old 6-year rule, section 118145, and it's 6 years covered if you rent it out during that time. If you don't rent it out, then it's an indefinite period of time. It can be covered with your main residence exemption. So both those properties are great to inherit. Another possible property you could have is a holiday property that was purchased after the 20th of September 1985. Just because it wasn't used to produce income doesn't stop capital gains tax applying. So the heir that inherits this gets a cost base of the price you paid for it, a bit of stamp duty, conveyancing costs and the improvements that you might have made to it. Now if you purchased that property after the 20th of August 1991, they can also increase this cost base by anything associated with the property that hasn't been claimed as a tax deduction. Now this can go as far as cleaning materials, rates, insurance, lawn mowing, fuel, interest on the property, on the loan for the property, just about anything that you can link to the property, but you've got to have kept the records. So good record keeping and this could help this property. Probably the worst one in the bunch is a rental property, because all those rates and insurance and everything else have already been claimed as a tax deduction. Further, during the time that you've owned that rental property, you may have been claiming building depreciation. And if you purchased that property after the 13th of May 1997, then you have to add back to the cost base, in other words, reduce the cost base by the building depreciation you have claimed. This means that the property is going to be possibly have a cost base of even less than what you paid for it. So you can see, even if you manage to give your children each a property of equal value when you die, some of those children may feel considerably ripped off because of the capital gains tax liability they inherit. You might throw up your hands and say, well, sell the lot and just distribute the cash and then I know I've been fair. Well, that introduces another beneficiary of your estate, the taxman. Yeah, the taxman, yeah. And no one wants to do that. So it's worth giving it a try. It's worth good record keeping and planning. Now, I'll just show you how these numbers work. So, say for example, you purchased a property for $200,000 and now it's worth $600,000. You may have spent $20,000 on stamp duty and solicitor's costs, so your cost base is $220,000. But it's a rental property, so you may have claimed depreciation of up to maybe $50,000 during the time you owned it. That'll bring your cost base back down again to $170,000. If you have a selling price of $600,000, that gives you a capital gain of $430,000. Now, I don't think this is an exaggeration. I'm sure there are plenty of people in Sydney now that have a gap here of $1 million in capital gain. Now, the capital gains tax discount would apply in these circumstances because the 12 months is from the time the deceased purchased the property, not from the time the heir inherited it. So 50% discount brings the taxable gain down to $215,000. This is added on to the beneficiary's taxable income, bound to put them in the maximum tax bracket, and you could expect that they probably lose at least $100,000 in tax. That means that they didn't get $600,000 worth of assets, they only got $500,000 worth of assets. There is no tax on transferring your assets in specie, that is the actual property itself, across to your heirs, providing the heir is a human being who is a resident of Australia for tax purposes. More about that next week. So if your heir doesn't sell the property, they just pass it down to their heirs, no tax is ever going to be paid. It's pretty simple to avoid capital gains tax, don't sell. And this gives them a chance to do it. It's just a matter of working out what is fair and preparing your will the best way possible. I'm going to cover all the strategies that you can use to minimise the tax to your heirs and what records you need to keep to give your heirs every opportunity to minimise their tax if they do have to sell next week. So please stay tuned, and thank you for staying through to the end. Please feel free to share this webinar with your friends, and I hope to see you next week.